I mean, so Jonathan, what do you tell your clients right now that are looking at this scary price action?
Well,
what should they do?
First of all, you can't look at the price action and make a decision. You really have to break it down into two issues. One is, what is the damage that this is doing to S&P profits, not for the week, but let's say over the course of the year? We started the year, our estimate was that we're going to have 6% EPS growth for the S&P. We think that that's going to be about a zero, but that's nowhere near what you would get in a typical recession, but a lot of damage. And the assumption there is that this plays out when you get towards year end and gets under control. So the damage in terms of profits is a first half issue. And in the back half...
How do you know that? That's not what the market is telling you right now.
Well, you can't look at, and Joyce and I were talking about the liquidity issue. You can't look at it at an illiquid market that's doing what it's doing as a signal, and we don't know. But if you listen to the experts, if you look at what past recessions have meant for earnings, that's probably about as good a guess in a changing world as you can make.
Joyce, we didn't expect today to walk in with oil being down 25%. Everything else on Friday, at least, we had a lot of questions, very few answers about the virus. Certainly people over the weekend may have made assessments in terms of the spread and everything else. But this was unexpected. What is the impact of this fall in oil prices from your opinion?
Well, what we're going through now is the great liquidity shock that we had been warning about as one of the fallouts from the global financial crisis. So not only have you had the stress in the credit and the funding markets and having that spill over into the S&P, you have the uncertainty now brought on by oil prices. So it's a question now of what gives. At what point do people feel like the prices are so low that they need to come back to the table? What pressure can the other 20 countries actually put on Russia, not just Saudi Arabia? But I think the liquidity moves that we've seen have been unprecedented, and it is a reflection of how the market has changed and how the market structure has changed. We just don't have those circuit breakers and shock absorbers anymore.
What do you mean?
So it used to be that you had banks holding some of the inventory for this. Now you've really had to have the Fed step in. The rise of algorithmic trading, electronic trading, record inflows because of passive. We thought there would be a testing moment, but who thought it would be on coronavirus or on what we're seeing in the oil markets?
Although we knew it would probably be something.
Yes, right? We knew it would be something. And the problem is coronavirus, for those quarantines to work, it's taken 8 weeks. Now we're seeing that China is peaking, but that was an 8-week process, and we have a number of countries that are really just coming into this right now.
China did draconian things that this country's certainly been unprepared to do at this point. Jonathan, how should we view the oil price drop? I mean, you can certainly make a case that it's positive for the consumer at home who's driving an automobile. At the same time, there's questions not as much about bank balance sheet, but certainly in the high yield market. There are questions just overall about what the impact is going to be and what a reflection is. It is still of reduced demand.
Right. Well, so I think that you raise an interesting point here, which is what does this ultimately do to credit? What does this do to areas like employment? What type of a spillover is this? So first, in terms of today's news flow, we have to separate out which of this was just this economic impact, which was already pushing oil prices down something like 30%, versus something specifically around, Saudi Arabia and Russia and something that's independent.